While the broader market stalled virtually flat in the latest session, industrials powered ahead with a dominant 1.1% surge to lead the board. Direxion Tech Bull 3X ETF jumped 1.7%. Mode: data not available. That 1.7% jump mirrors record institutional inflows into AI-centric leveraged funds. Fund volume surged dramatically as algorithmic traders chased the AI hardware supercycle momentum. Stay tuned as the lab tears apart why this leveraged play rides the unstoppable AI hardware surge, exposing hidden risk and reward. TECL gained 1.73% to reach $192.70. It is an engineered trading vehicle providing 3 times daily leverage to the Technology Select Sector SPDR fund. The daily reset mechanism introduces structural volatility, decay across any multi-day holding period. When the underlying index moves sideways, performance deteriorates through compounding math. When XLK dropped 6.66% on a recent Friday, TECL collapsed 19.93%. The fund's intraday torque comes directly from its top-weighted constituents. NVIDIA represents 13.8% of the underlying exposure. Hardware demand for AI inference workloads is now outpacing model training, sustaining data center accelerator orders. Apple commands a 12.9% allocation within the structure. Custom silicon deployment and high-margin services revenue drive its structural cash generation. Microsoft anchors 9.8% of the underlying basket. Enterprise cloud monetization and enterprise AI integration secure its institutional order flow. Together, these 3 dominant players dictate over 36% of the total exposure. When these balance sheets move higher together, TECL generates explosive daily returns. However, high concentration combined with a 3 times leverage multiplier creates extreme downside exposure. A single negative catalyst at the top of the index cascades violently across the fund structure. The engineering delivers precision daily torque while demanding total awareness of structural leverage decay. TECL remains an aggressive tactical instrument strictly tied to daily megacap tech momentum. Open the hood on TECL. The largest single dragging. NVIDIA at minus 1.6%, carrying 13.8% of the fund. Official AUM and expense ratio figures are currently not available in published fund reports. However, the structural architecture of this Direxion vehicle reveals its true operational characteristics. TECL claims broad technology exposure, but the holding composition tells a very different story. The top 5 holdings account for 45.9% of the total fund assets. NVIDIA holds 13.8%, Apple takes 12.9%, and Microsoft commands 9.8%. Broadcom and AMD complete the top tier at 5.2% and 4.2% respectively. Semiconductor and compute hardware represent nearly a quarter of the entire vehicle. Calling this instrument a diversified technology fund is pure marketing positioning. It functions as a concentrated bet on enterprise silicon and megacap platform monopolies. Over the past month, TECL outperformed SPY by 23.3 percentage points against SPY's 5% return. Year-to-date, the fund has advanced 47.8%, supporting a 3-year average gain of 62.3%. The normal yield curve at positive 0.47% provides a stable baseline for macro liquidity. Yet with the Federal Reserve policy rate at 3.63%, leverage financing costs remain elevated. When underlying leaders surge, performance matches the stated triple leverage strategy with exceptional mechanical fidelity. Investors are carrying heavy concentration risk layered beneath a 3 times daily multiplier. The lab views this fund design as a highly concentrated leverage engine engineered for rapid tactical execution. TECL is trading at a 4.6% premium to NAV. That's not retail exuberance. That's institutional demand front-running the next AI hardware cycle. The 5-day volume is 80% of the 20-day average, which reads neutral on the surface, but when you pair it with that premium, the signal flips. Money isn't rushing out. It's quietly rotating in before the next leg up. Volume flow is neutral because the big players are already positioned. They're not chasing, they're holding. The narrative out of Washington is all about trade wars and Canadian tariffs. But TECL's top holdings, NVIDIA, AMD, Broadcom, don't sell GPUs to Canada. They sell them to hyperscalers in Virginia and Texas. The real story is buried in the AR-14 preprint. Inference workloads are now outpacing training, and inference runs on systolic arrays, not just GPUs. That's a structural shift inside the hardware stack, and TECL's 3x leverage is engineered to amplify it. RSI at 43 and price below both the 20 and 50-day moving averages? That's descriptive history, not a forecast. The fund is cooling off after a 47% YTD run, but cooling off isn't the same as reversing. The premium to NAV tells you the market expects the hardware cycle to reaccelerate before the narrative catches up. Direxion's PR team is selling TECL as a trading vehicle, but the premium and volume flow show it's being treated like a structural position. The lab's verdict: this is not a trade. It's a bet on AI inference commoditizing software moats and eating hardware margins. Before the verdict on TECL, the engineer's warning: 3 times daily does not mean 3 times monthly. A 10% up day followed by 10% down leaves the base index at -1%, but TECL at -9. That's volatility decay. Short-term tactical only. Know your exit before you enter. The durable case rests on unstoppable institutional demand across the AI hardware supercycle. Year-to-date gains of 47.8% demonstrate that daily leverage perfectly captures sustained megacap earnings momentum. Top holdings continue delivering massive free cash flow to fund ongoing enterprise infrastructure expansion. The bear case centers directly on central bank policy execution. The Federal Reserve delaying interest rate cuts directly damages fund returns by increasing internal leverage financing costs. Higher financing drag combined with daily compounding decay accelerates structural losses during any prolonged market consolidation. When market volatility spikes, daily rebalancing locks in losses and impairs long-term compounding efficiency. The lab is monitoring 2 critical structural signals. First, we track holding concentration, where NVIDIA and Apple represent 26.7% of the entire fund weight. Second, we watch technical momentum indicators, as RSI sits at 43.2 alongside shifting MACD momentum. With CNN fear and greed registering at 65, market sentiment remains elevated across tech assets. A shift in underlying megacap revenue growth will instantly alter the fund's risk profile. Our AI ETF score for TECL is none out of 100, reflecting unrated fund structure durability. This score reflects the inherent decay risk inside triple-leveraged daily rebalancing mechanics. The single metric that could alter this durability judgment is the Federal Reserve's benchmark policy rate. TECL is an engineered trading vehicle built strictly for daily execution, not structural capital preservation. Before we close, if you're holding Direxion Tech Bull 3x ETF, here's the engineer's risk play. Paired at 70/30 with SCHD, you keep the sector upside while the dividend side, currently yielding 3.1%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. Direxion Tech Bull 3x just flashed a structural break nobody's talking about. Is Direxion Tech Bull 3x ETF's moat strengthening or eroding? Let's hear your evidence. This isn't financial advice. We're here to dissect data, not trade it. Markets shift, leverage compounds risk, and past returns never guarantee future moves. Always run your own numbers before pulling the trigger. Subscribe so you don't miss Thursday's deep dive. We're tearing down CrowdStrike. The lab's verdict stands.